You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
I need to say that the person that I'm going to describe next is not me. But if you have a mind for narrative, if you have a mind for popular culture, and if you have a mind for trading, there is a viable business to be had, not so much in understanding the project, but rather understanding the value of the public's perception of the project and the promotional plan. Trading promos, I'm tempted to say trading rigs, for the right, completely cynical lone wolf trader can be an extraordinarily profitable activity.
Thank you for tuning in to another episode of Mining Stock Education. I'm your host, Bill Powers. Well, with gold now over $1,800 US and silver over $19 an ounce, the precious metal sector continues to gain more traction. With me today is Rick Roll, the president and CEO of Sprott US Holdings. Rick also is one of the larger shareholders of Sprott Incorporated, and Sprott profits when the precious metals go up. They also service the precious metals and mining industry, and this stock is up over 150% since the mid-March sell-off lows. And the recent news for the company is now they are listed and trading on the New York Stock Exchange. So Rick, welcome back to the show and congratulations on the big board listing. And perhaps we could start off our conversation with you sharing what is the significance of this NYSE listing?
Well, thank you both for having me back on the show and also for your kind words concerning my employer. The rationale for listing on the New York Stock Exchange was simple. It is the deepest and most liquid equity capital market in the world. It is also a market that is a self-imposed constraint for some investors, which is to say some U.S. institutional investors have a New York Stock Exchange, a minimum listing requirement on the New York Stock Exchange. For ourselves, although we are a Canadian domiciled company, the vast majority of our revenues are in US dollars. The vast majority of our shareholders are American people, and the vast majority of our customers live in the United States. So as an institution, we are certainly more American than Canadian. We report in US dollars. We service U.S. customers and we're owned by U.S. people. The idea that we ignore a listing which would be in the best interest of all of our constituencies, while at the same time allowing us access to the deepest, most visible, and most liquid capital market on the world, is silly.
I believe you've told me in a past conversation, Rick, that your lending division was one of your most profitable divisions of your company during the bear market in precious metals. So regarding the lending business, is it going to be tougher for that aspect of your business to be profitable in this bull market? Because I think it would increase your competition.
Judging by the backlog that we're enjoying in the lending business will continue to grow. The reason, or at least one of the reasons why the lending business was so profitable in the bear market was a lack of access to capital among good projects. That capital is less scarce now. But at the same time, with increased access to equity capital, more companies can access capital markets to build projects. So ironically, we are seeing more projects now than we saw at that point in time. The second thing that happened is our own access to capital. We lent in the beginning off of our own balance sheet and by syndicating loan participations to some institutions and some high net worth investors. When we went to institutional capital markets to put together a fund, after some effort, we were able to raise about $500 million. Our second institutional fund cleared through $800 million fairly easily. And along with committed joint venture partners, the capital that's available to us with a phone call now exceeds $1.5 billion. And our ability to complete larger transactions with syndicate partners is larger than that. So I would suggest that our reputation and market reach, our access to capital, and the fact that we can present basically a full stack solution to companies needing finance, which is to say that we can arrange a streaming transaction, a royalty transaction, a lending transaction, and an equity transaction, puts us in a very enviable place to grow what is also already a highly profitable business.
At Sprott, when you're analyzing the feasibility and pre-feasibility studies that these development companies bring to you when they're looking for capital, we see these companies often use discount rates of 5%, or if they're in a non-top tier jurisdiction, maybe 7 or 8%, or if they're really honest, 10% or more. But when you're doing your work internally, what type of discount rate do you typically apply to development projects when you're calculating your risk as a lender?
It's really a function of the cost of capital, but it's disingenuous, I think, for a pre-feasibility stage company to use a 5% discount rate on the project when they know that their cost of capital is going to be 15%. Interestingly, of course, the discount rate in the feasibility study is only one factor that we take into account. Certainly, in terms of a credit discussion, that's an important discussion. For us, a more important criterion is who, other than the borrower, is the asset strategic to? And if the borrower had completion problems, who could we sell the project to, and for how much in one set of circumstances? If a borrower was looking to borrow $100 million from us to build, let's say, a gold mine in Ghana, who operates gold mines in Ghana in reasonably close proximity to our borrower's gold mine, and how might this asset be strategic to them in the event that our own borrower was unable to complete? We are not a loan-to-own shop. We are lenders. And so we need to know that if our own borrower experiences difficulty, who can and will step into the shoes of our borrower. That's probably a more important lending criterion than strict adherence to probable discounted risk-adjusted net present value.
And what are you using for commodity price when it comes to gold, the gold price? Because I sat through about 30 presentations one-on-one at the Beaver Creek Precious Metals Summit last September when gold was about $1,500, and the overwhelming majority of them were using $1,250 gold. Do you use the trailing average of the past 2 years for your gold price when you're looking at these projects?
We use the forward strip. The forward strip is never right, but it's the most honest of all forecasts because it's the forecast that people are using their own money to support.
And Rick, you mentioned at the outset of why you chose to list on the New York Stock Exchange for Sprott. When you're advising or you're invested in one of these gold juniors that seems to be picking up market traction, and they make the decision to jump from the OTC to the NYSE American or NASDAQ or even the New York Stock Exchange, like Integra announced last week, I believe, what would be your advice to a company considering a move like this?
People who have the ability to do it absolutely should do it. Why would you confine your listing to a country that has 7% of the North American capital markets contained within its borders, which is to say Canada? The U.S. market has vastly more capital, vastly more liquidity, and is, by the way, underserved with natural resource listings. So if you have a choice, there are some companies that are too small that don't qualify. But if you have your choice to facilitate trading in a much broader and deeper capital market, and one that is underserved rather than overserved, it's a very, very simple equation.
Would you say, though, that some companies that are too small, that maybe raise $2 to $4 million a year to engage in exploration, that the listing requirements and the costs and the lawyers' fees perhaps would be too high, though, for it to be worth it for them to list on a big board?
Yeah, I think that's probably the case, but that isn't normally the thing that constrains companies, frankly. Many companies are Canada-centric. Either for reasons of sort of incipient nationalism among the managers, or also because the direct liability to officers and directors pursuant to Sarbanes-Oxley are much more extreme in the United States. It shouldn't be this way, but the truth is yield to director and yield to manager is often more important than yield to shareholder. In the case of Sprott, we had objections among our senior managers 3 years ago over the cost of a dual listing. And I suggested somewhat smugly, yes, you're correct. We don't need to be listed in two jurisdictions. Let's drop the Toronto listing.
But that can become problematic for some juniors, though, right? If they're only listed in the U.S. on a big board and they're not listed in Canada. I've talked to people where they've object over investing, saying, well, the NI 43-101 requirements don't apply to them, so should I trust this U.S. company maybe a little less?
I don't think that if you look at companies like Uranium Energy, as an example, UEC, that being listed in the U.S. only is particularly burdensome. What it does do for issuers is it forces them to find different capital markets participants. You can't just trot down to BMO or Haywood or Canaccord. You have to, in fact, access the U.S. market. It has been extremely convenient for Canadian management teams to walk 4 blocks to Bay Street or walk 3 blocks to Howe Street and access typical Canadian distribution during bull markets. And frankly, the consequence of that is that Canadian companies often have gone broke during bear markets. So certainly it imposes a hardship on managements. It makes them work harder. It makes them broaden their source of capital and broaden their source of distribution. It might cause them to drink less at Joey's or High's and have to broaden geographically their source of libation. But it's a good move.
We'll be right back after this word from our sponsor. Orin Resources is a junior exploration company with the appetite of a major, focused on finding the next globally significant discovery to create enormous potential upside for shareholders. It's one of the most aggressive exploration companies pursuing high-grade, scalable gold and copper deposits, and has a premier 7-project portfolio, including its 2 flagships, Committee Bay in the Arctic and Sombrero in Peru. With Orin's unparalleled technical team and highly experienced management with a history of success in advancing and monetizing exploration assets, Orin has been called one of the best in the junior exploration sector. Orin trades on the TSX and NYSE under the ticker AUG. To learn more, go to aurinresources.com. That's AURYN resources.com. Rick, I've heard you say that smarter management teams you've observed in the natural resource sector tend to gravitate towards the royalty business because it's simply a bit better business model. How does what you've said there compare or contrast with also your affirmation and willingness to finance non-royalty model entrepreneurs in the mining sector, such as Ross Beatty, Keith Neumeyer, Ivan Bebic, just to name a few?
Well, the idea that the whole of the industry should be attracted to a better business plan would ultimately make that business plan a less good business plan as a consequence of competition. I would point out that Ross Beatty, as an example, did spawn a royalty business called Mavericks. And he was, of course, attracted to and has executed the royalty model well. The truth is that we have been for 40 years active in all aspects of mineral exploration and production. What is important is that you match the right team with the task at hand. There are some management teams that do an extraordinary job as prospect generators, as explorers. There are other people that do a good job attracting advanced exploration projects, applying new technology, new talent, new capital, and finishing them off. There are teams that do a good job of acquiring assets and building them, and either operating them or reselling them. There are probably 10 or 12 primary ways to make money in the junior resource business. And I'm not going to say I'm agnostic, but I certainly have experience in all of them. The royalty and streaming business has a much better track record over the last 20 years than any other form of business organization. I'm not trying to say that other companies haven't made more money individually than royalty and streaming companies. I'm trying to say that the return on capital employed and the return on equities across the board in royalty and streaming has been much higher than similar metrics in other parts of the business. But the truth is, if a Bob Quartermain or a Ross Beatty or a Clive Johnson came to me with a business plan that didn't involve royalty and streaming and said, you know, I have a 7-year vision to build this company in the following manner, I would be very likely to say yes.
What would be your advice to newer resource investors that are getting excited about this precious metals bull market and they're looking at mining equities in the junior gold space? What would you tell them to look for so that they can discern between a genuine mining entrepreneur that's launching a gold company at this time while the market's hot, but he or she truly wants to build value, versus a promoter that's starting a quote unquote gold company looking to attempting to mine investors' wallets rather than find and build a mine?
I need to say that the person that I'm going to describe next is not me. But if you have a mind for narrative, if you have a mind for popular culture, and if you have a mind for trading, there is a viable business to be had, not so much in understanding the project, but rather understanding the value of the public's perception of the project and the promotional plan. Trading promotes, I'm tempted to say trading rigs, for the right, completely cynical lone wolf trader can be an extraordinarily profitable activity. I can't do it, so I don't do it. I'm one of those people who, with regards to popular culture, can't dress himself and doesn't go to movies. So my ability to understand the impact of a narrative and the sort of appropriateness of a promotional strategy is very limited. For me, I have to look at who the people are involved in the project and what it is about their track record that suggests that they will be successful with that project. It isn't enough that they intend to be perhaps in the gold exploration business. Do they have a prior track record of success in gold exploration? Do they have a prior track record of success in this deposit type? Do they have a prior track record of success in this or a similar jurisdiction? So you need to define success fairly tightly. Are their assumptions reasonable? In other words, their proposed sources and uses. Do the sources of funds that they describe actually exist? Are the uses of the funds that they propose likely to be sufficient for the task that they propose? What is the percentage of money raised that would go to general and administrative expense rather than going in the ground? How much stock does the management team own, and what price did they pay for it? In other words, what is the lift? I've seen circumstances recently where management teams assigned themselves 20 million shares for nominal consideration and then proposed to allow me to invest $1 million at 25 cents a share, saying that they were involved. Well, of course they're involved. They have 5 times as many shares as me, and they haven't put up any money. So there are a variety of things that speculators and investors need to do, most of which involves common sense.
Rick, what do you think about companies that, like, say, have silver, or a large component of their project is silver, but yet they have the word resources, ABC Resources, for their company name? Would you, if you were a shareholder, would you be for them throwing the word silver, taking out resources and putting in silver, just because that will attract a lot of retail capital if silver really heats up?
I think if the company's ultimate mission is to become an explorer that is not commodity specific, and if their first project is silver centric, but ultimately they see themselves, as an example, as epithermal explorers, I can understand the moniker resources as opposed to silver. But if in fact they intend to be silver centric, traditionally in bull markets, there has been a scarcity of silver equities. And traditionally, at both the retail and the institutional level, there has been a fondness for silver that makes silver equities in speculative markets outperform the rest of the precious metals complex. So to the extent that the company is going to be silver focused, I think it absolutely makes sense to tap into the silver franchise.
This question deals with a hot stock of last week, Vizsla Resources, that put out some phenomenal grades, discovery there in their project in Mexico, and the stock went up over 100% on the drill results. And if I just pull up my stock chart, I see that I got up to at least 285, if not higher. But then they did a financing at Canadian, and I'm speaking in Canadian dollars, Canadian 187 per unit with a warrant at $2.40. So both the warrant and the underlying share were listed below what the stock ran up to after the discovery. If you were an investor and not the broker negotiating this bought deal, would you be happy with this? And what would you want to see on the heels of a phenomenal drill hole?
I need to disclaim that, first of all, I don't want to give name-specific investment advice. So a discussion of Vizsla will be for educational purposes rather than a discussion that relates exactly to this issuer. This is a high-quality team, very high-quality people, and they have access to a high-quality project. I use the word access because they don't own it yet. They need to complete a fair amount of work, and they need to pass several financial milestones. So it's important that investors who look at a company like Vizsla on an asset basis understand that the only assets that they have right now are intellectual capital, a fair bit of physical capital, and the ability to buy the underlying asset. Vizsla was structured in a way that started the company off in tight fashion, which is to say that the share float wasn't there, and it would be extremely susceptible to good news. It was also a company that was structured in a way that people who have the ability to influence the market were allowed in as reasonably early shareholders. So any good news that came would certainly be amplified. If you were a shareholder of Vizsla and your average was 1 cent or 10 cents or 50 cents, the idea that the stock was now trading at $2.80 after what was, by the way, a truly spectacular drill hole in a very attractive target, it would be in your interest to use the interest in the stock engendered by the result, engendered by a very high quality promotional package, and engendered by the tight float to leverage off the willingness of the market to pay $2.40 or $2.50 and give you access to using capital that came in an amount that was at sort of 10 times your average cost. So it depends on who you are. From the point of view of the constituency which is closest to the officers and directors, that is to say, the close and early shareholders, the large shareholders, and the people who enjoyed the promote stock, the action that they took was absolutely rational. From the point of view of the retail speculator, who maybe paid attention to newsletter recommendations without understanding the options term, and without understanding necessarily the market capitalization or the structure that came into this financing, the financing was probably less advantageous. So I think your response to this financing depends on who you are and what your interest is.
Rick, I'd like to get your take on one more occurrence in the gold sector. I will mention companies, but I'm not asking you to specifically comment on those companies. Just put that out there as a preface. Argonaut and Aleo, two producers, merged. And then after their merger, the new entity, Argonaut Gold, announced $110 million Canadian bought deal financing, and this is for cash flow positive companies. My question for you is, if you were an investor holding shares of this entity, Argonaut Gold, do you want to see them issue shares and dilute existing shareholders, even if they're going to use this for CapEx purposes? Or with gold where it is now, would you rather have them be a little more patient and use the future profits now with this higher gold price to reinvest back into their mines?
Many questions packed into that. So let's try to deal with them one at a time. I am extremely supportive of horizontal mergers. The market has shown that scale matters. The market has shown that multi-asset companies trade at a premium to single asset companies because of the perceived lessening of risk. History has shown that management teams that have the ability to allocate investment across a range of assets, rather than having to force investment in one asset to maintain their salaries, perform better over time. And it is certainly true that mergers intelligently constructed lead to higher assets under management with lower general administrative expense. per dollar of either cash flow or AUM. So intelligently constructed mergers are almost always beneficial, and I believe this one is no exception. As to the decision as to whether to dilute or not to dilute, really it depends on the use of proceeds. If the management team can show that access to capital now, 2 or 3 years out, is accretive to risk-adjusted net present value on a per-share basis, or accretive to free cash flow per share on a per-share basis, then it is an intelligent decision. If, however, the company is issuing shares to raise cash simply to increase the mass of AUM and the certainty of salary for the management team, these are bad circumstances. There is not one size-fits-all answer. People who are shareholders of companies like Argonaut and Alio need to be present on the quarterly conference call, and they need to be vocal with management in saying, I understand the rationale for the merger. I support the rationale for the merger. Could you please lay out for me the development proposals that you have in terms of priorities for the assets of the new company? And could you also, if you propose to do an equity financing, explain how the dilution in the equity financing that we suffer now will benefit us in terms of higher net asset value and higher free cash flow per share 2 years from now or 3 years from now? In other words, discuss the net present value per share implication of the financings. Most retail investors, and frankly, most institutional investors, live for the quarter. And most investment bankers live for the fee. So the questions that I've described to you seldom come up in the conversation. The question that most shareholders seem to ask themselves is, where will the stock be 2 weeks from now? A question that frankly can't be answered with any certainty, and as a consequence is fairly irrelevant.
Rick, thank you for that thorough and educational answer. And before you leave, I should have you touch on the Sprott Natural Resource Symposium, which because of the whole COVID crisis is now going virtual. Please bring us up to date on this.
Well, thanks for the opportunity to do that. Many of your listeners know that for, 25 or 30 years, we and predecessors have put on a conference in Vancouver, the Natural Resources Investment Symposium, and it's been extremely successful, even through the bear markets. Successful largely, I think, because, as an example, any exhibitor there needs to be owned in Sprott performance fee generating accounts, which is to say that we have vetted all the exhibitors. Unfortunately, Bill, the fact that Sprott owns it doesn't guarantee that it goes up in price, but it does guarantee that we know the exhibitors well enough that we've taken the risk to own them with our own money. We have also always attempted to spend a lot of money on content and bring people a wide range of speakers, both gurus, the Daniela DiNamartino Booths, the Jim Rickards, the Doug Caseys, all of those. But more important, serially successful mining operators who can explain how their success came about and what the lessons that they've learned building mining companies can affect the way that our attendees manage their own portfolios. What's different this year is, of course, as a consequence of this damned virus, that we can't all be together in Vancouver enjoying the wonderful summer weather and taking harbor cruises and things like that. This will be a virtual conference, an online conference. Two things about that. What will be missing is the organic part of the conference, where attendees, high net worth, smart individuals get to talk to each other, and where they can get candid off-the-cuff remarks from the exhibitors and speakers. As an example, on the boat cruises, where I ply all parties with alcohol and a chance to simulate candid discussion. What's good about this, however, is, first of all, I cut about $400,000 in structural cost out of the conference. Hospitality, travel, lodging, which allows me to spend more money on content, on intellectual capital. The second thing is it frees us from the tyranny of time, in the sense that many attendees have told us over years that one problem with the conference is that there would be 4 workshops taking place simultaneously, and the attendee wanted to be at 2 or 3 and had trouble making up his or her mind where to be. In this circumstance, with a virtual conference, you can attend those workshops either sequentially, one after the other, or online, toggling back and forth between them as you see fit. So we have been able to make real improvements in the formal content of the conference. Now, we've also made substantial investments in technology for the conference, largely by watching and attending video conferences that have gone on before us. And I'm pretty confident that this technology will work. But what I'd like to say to your listeners, Bill, is the following. I'm going to make this riskless. If anybody becomes a paid attendee for this conference and believes at the end of the conference that he or she has not got their money's worth, I will refund personally 100% of the attendance fee. Now, I'm not saying to people this is a free conference, that all you have to do is ask for your money back. You have to say, preferably in an email, specifically why you don't believe you got your money's worth. But the truth is, anybody who attends this conference and doesn't believe that they got their money's worth will get a full refund from me. So the risk associated with the content and the risk associated with the technology is mine, not the attendees.
And the cost here, I'm looking, it's $299 US dollars, and I will put a link to it in the show notes below. So make sure you click on that link and check it out. I mean, it's a risk-free proposition you've just laid out there, Rick.
That's right. Risk-free to them, some risk to me.
Yes.
But the truth is, I'm highly confident in our ability with this range of speakers and this wonderful range of exhibitors. I am highly, highly confident that this is riskless to me as well.
Well, Rick, as always, you've provided us with a half an hour of mentorship and discipleship here in natural resource investing. Thanks again for coming on today's show.
Bill, it's always a pleasure. Thank you for having me on, and I hope you're present at the conference, at least virtually, to enjoy it.